Let's look at one more example of deferred taxes. Exercise 3. The DeVille Company reported pre-tax accounting income on its income statement as follows. 2018, $350, 19, $270, 2020, $340, and then 2021, $380. Included in the income of 2018 was an installment sale of property in the amount of $50,000. However, for tax purposes, DeVille reported the income in the year cash was collected. Cash collected on the installment sale was $20,000 in 2019, $25,000 in 2020, and $5,000 in 2021. So notice, all 50 of it was in our 2018 income. But for tax purposes, we would record it in 19, 20, and 21. So for tax purposes, we would not report any tax on that $50,000 in 2018. In addition, included in the 2020 income was $15,000 interest from investments in municipal bonds. Again, this is not taxable at all, so we need to back that out for both the tax for accounting purposes and for our actually income tax statement. Okay, just in 2020 though. The enacted tax rate for 18 and 19 was 30%, but during 19, new tax legislation was passed, reducing the tax rate to 25% for the years 2020 and beyond. Prepare the year-end journal entries to record income taxes for years 2018 through 2021. Again, the cool thing is the entries are very much the same each year. We're going to debit income tax expense, and that's going to be the amount that we will record on our accounting financial statements, our income statement. Then we've got our income tax payable. That's the amount we would actually pay to the federal government for our income taxes. State government, whatever that happens to be. All right. So here, we first need to find in year one, all the rates are the same at 30%. So basically what we can do is find our income tax expense by taking our taxable. Now in 2018, it's $350. There was no non-taxed items. To find our accounting income tax, we would take $350,000, multiply that by the enacted rate of 30%, and that would give us total income tax expense on our income statement of $105,000. Now, go to income tax payable. Well, we start with the $350, but of that $350, $50,000 of that income is not taxable this year. It's taxable in future years. So for taxable purposes, we only have income of $300,000 times 0.3. That brings us to income tax payable of $90. That's what we have to pay to the taxing authorities, the governments there. Now, that brings us to our difference. Well, this is going to create more tax in the future. Notice we only paid $90, but eventually we will have to pay tax on that. So that's called a deferred tax liability because we will owe more in the future as a result of this transaction. And it's going to be the $50,000 that we're going to owe tax on at the 30% rate at this point. So we're creating a $15,000 deferred tax liability. Now, when will that correct itself? Well, it's going to correct itself in 19, 20, and 21. $20,000 in 19, $25,000 as far as income goes in 2020, and $5,000 in 2021. So let's look at the 2019 entry. So again, December 31st, 2019. Now the cool thing is, I'm not going to copy it, we'll actually type it this time. So income tax expense, and then we know we're going to have income tax payable. We know we're going to consume some of the deferred tax liability. How do I know that? Well, at this point, we're starting to consume it because it's going to correct itself these 3 years. Okay? So when it starts to go away, we're going to hit our deferred tax liability for a debit. Now, notice in this year, we had a tax rate change for future years. Now, granted, in 2019, it is 30%. But by the end of 2019, we know new tax legislation is passed and future rates will be 25%. That's actually good for us because what that means is instead of having to pay 30% over the life on that $50,000, it's going to go down. We're going to save 5%. Now, the downside, in the year that we know the change happens, the deferred tax liability cannot be carried at 30% anymore. It now needs to only reflect the 25%, which is what it'll cost us in the future. So this is one of those instances where, one, we need to find the income tax payable. Well, how do we do that? Well, first we go and find what was our taxable here. $270 was our accounting income. But remember, we need to add back that installment payment. And in 2019, the installment payment was $20. So for income tax purposes, we had a total of $290. Now, we're going to multiply that by the rate. Keep in mind that 25% is for future periods. In 2019, we still have a 30% tax rate. So we're going to multiply that $290 times 30%, and that gives us $87,000. Now, we cannot simply calculate the income tax expense in the year we know the change happens. We basically have to find how much we need in the deferred tax liability. So how much do we need there? Well, we had $50,000 in total minus 20. Okay, that gives us $30,000. Now, that $30,000 is future that we will have to pay tax on, and we're going to pay on that $30,000 at a rate of 25%. Okay, so when we do that, let's multiply that out. So 30 times 25% gives us 7,500, 7.5. Now, that's the future balance in the account, because 30,000 is what we're carrying forward. We can't just simply take the 20 times the 30%. Will not work in this case because we have to adjust. We no longer need to carry the balance at 30%. We need to change that to 25. Well, how much did we already have in there? We had 15. So that means we need to bring the balance from 15 down to 7.5. So our entry for this would be 7,500 in the year of the change. Because we're not taking the straight 30% anymore, because we need to adjust how much we're carrying this 15 for. Now, if the rate had not changed, if the rate had remained 30% throughout this entire problem, you could simply take the 20 times the 30% and get your amount. No problem. That's how much of it would actually come back to us. But since there was a rate change, we have to base it off the end balance. So we know we have 30,000 we have to carry forward into the future. Multiply that by the 25%, the rate that will happen in the future. So in other words, we're going to be taxed on this 30 later in life at 25%, not 30%. So that means we should only carry forward $7,500 into the future for future taxable earnings, or future income tax payable, excuse me. We already had 15 in there, so this year we need to back out 7,500. One, to show the current rate. Notice the current would be 6,000. If you took the 20 times 30%, it would be 6,000. We need to correct the prior period for the 15,000. Need to bring it down to the rate of 25%. Okay, so that corrects it. All right, so then this year, since there was a change, we actually have to plug our income tax expense, which would just be the difference of 79,500. So that is one of the catches during the year of the change, when the rate we know going into the future is going to be higher or lower. In this case, it's going to be lower. We have to find the deferred tax liability for future periods, and then we have to back out to find the actual income tax expense, or plug is a better word, I guess, to say. All right, so let's look at 2020. What's going to happen there? Well, same entry. The entries really don't change a whole lot here. If I can get to typing right. And then we've got our income tax payable. Now, we find these two. Again, we know for a fact that we're using up the deferred tax liability, so that will be a debit. Because it started with the 50, it's going to go down to 0 over time. So in this year, we're going to calculate that. Now we're back to all the rates being the same, so let's start with the income tax payable here. Now, our accounting income is $340, but we get that installment sale, and let's see, this year the installment is $25. So we're going to add that in, but we've got to remember this 15 is not taxable either. So this is going to be a weird year. We're going to take the $340 minus the 15 first. Okay, and that is going to bring us, excuse me, that's going to bring us to our $325 there. Then we need to add back the installment sale of 25. So for tax purposes, our income is 350 times, now remember our rate now is 0.25. So when we multiply 350 times 0.25, we get 87,500. Now, let's find our income tax expense. Now for income tax purposes, for accounting purposes, our income was 340. But remember, in both cases, the 15 is not ever going to be taxed, so we need to back it out as well. So we do not need to report income tax expense on your income statement either for that 15. So that brings us to 325. Then we're going to multiply that. Again, our rates are the same at 25%. So we take 325 times 25%. We get 81,250. Oops, forgot to tab over. There we go. 81,250. Now, we could just plug our deferred tax liability, or we can prove it out. Well, remember, we carried forward a balance of 30. So we're going to take 30. We just used up 25 of it, so that's going to leave us 5,000 in future earnings that we're going to add to our future income statement. We're going to multiply that by 0.25. Okay, and that's going to give us 1,125. Okay. Excuse me, 1,250. There we go. Notice 1,250. Now, we already had a balance in that account of 7,500. So again, take that minus 7,500. That gives us 6,250. Notice, that would leave us, because we had 15 minus 75, that gave us a balance of 75, minus 6,250 would give us 1,250. That's what we need to have in that account to carry forward. Alright, and then in the last year, the entry is going to be the same. Income tax expense, income tax payable. Now, are we going to add to our deferred tax liability, or are we going to use up? We're going to use the last little bit, because this is going to be our last installment payment. So therefore, we will have no future tax liability. So we're going to finally use that last little bit. So let's, like we have been doing, start with income tax payable. We start with 380. There was no weird stuff this year. The only thing we have to add in is that $5,000 for that last installment payment. So that brings taxable to 385 times 0.25. That's going to give us 96,250 in income tax payable. Our income tax expense, this one's going to be an easy one because there's nothing weird. So we're going to take the 380 times the 0.25, and we multiply that out. We get 95,000. So then what's the last thing? Well, we can either plug it, since the rates are the same, or we can calculate to make sure we are doing this correctly. Notice what should be our balance. Well, it should be 0 now. Why? Well, we started with 50 in year 1, right? So go back, we started with 50. We used 20 of it. We used 25 of it. Now we've used the final last 5. So at this point, we should have 0 tax liability in the future as a result of this installment sale. Okay. We already had a balance of 1.25 in there, 1,250. So that means 1,250 would come out. Notice that's exactly what we need to balance out the equation. So hopefully that has helped understand why we have these differences and how to calculate the income tax payable, the amount we have to pay the government, versus our income statement tax, what we actually report in our financials, and why they're different, and then what happens in the year of a tax change.